Welcome to the I Triumph Real Estate Blueprint Podcast, where greatness awaits you.
Can you explain the difference between, let's say, a fixed rate mortgage and an adjustable rate mortgage? I know there's a lot of buzz out there right now when people are a little afraid because they think that there's this huge crash that's getting ready to take place within the financing sector as well as the real estate sector, which kind of go hand in hand.
Sure. On a fixed rate mortgage, typically it's either a 30-year, most are 30 years, but you can take 30 years or any amount of years that you want. It could be 15, 20, whatever time frame you want to finance for. And the rate will stay exactly the same for the entire period of time. When you do a variable rate, they come up with what's called a margin, and they decide that the rate for today used to be the rates were lower. So you started out at a lower rate. It stayed the same for a certain period of time. You could set it up so it stayed the same for 3 years, 5 years, and even 10 years. At that point, it would adjust every single year after that based on whatever the current market rates were. So in the past, when rates were dropping, every single year after the initial period, when the adjustment period started, people's rates were actually going down with an adjustable rate mortgage. But in a market like this, where the rates are going up, if you get to that adjustment period and rates are higher, all of a sudden you get a higher interest rate on your mortgage, higher payment, and now it may be difficult to pay the mortgage that you had before. Because I do find that a lot of people, when they get mortgages, are kind of at the close to the ceiling of what their budget is.
Right.
People are allowed to do generally up to 50% of their income is what their debts can be, including the house. And a lot of people, because of the housing prices going up and the rates going up, they're getting very close to that limit. Well, if the rate's adjusted on an adjustable rate mortgage higher than that, all of a sudden a $1,600 mortgage might go to $2,000, and that's a struggle. The thing right now is, because the rates are going up so dramatically and so quickly, there really isn't a marketplace right now for adjustable rate mortgages. What happens in the market is that these are bought by investors. The banks bundle them up, they sell them to investors. So they say to the investors, hey, I got a whole bunch of 8.75 mortgages, 6.75 mortgages. Who wants to buy that block?
Right.
Nobody is buying variable rates right now. So what the lenders have done is made the rates no better than the fixed rates so that nobody will sign up for one.
Right.
So right now, they're not attractive. If the rates come back down, then they may make sense for a lot of people. But just at this moment in time, they're just really not something to benefit the borrowers. It's really the 30-year fix, because that's the longest you can extend it.